Hi, in this topic video we're going to take a quick look at a really popular model of strategic analysis called SWOT analysis. Now, SWOT analysis is just one of several models that a business can use, that management can use to assess where their business is positioned, both in terms of what it's good at, its strengths and weaknesses, and also the factors that are outside of its control. In other words, the nature of the external environment. So SWOT analysis is quite unusual in the sense it looks both at the internal as well as external issues facing the business. The SWOT analysis framework is a really simple one to remember. SWOT, the acronym, stands for strengths, weaknesses, opportunities and threats. And the key thing to remember about SWOT analysis is at the top half of the table is all about the factors that are internal to the business, things that are within the control of the business. Whereas the bottom half, the opportunities and threats, are all external to the business. In other words, they are outside of the control of the business, but the business needs to respond to them. The key thing when you're looking at the top half of the SWOT analysis is to try and identify genuinely what the business does well. So it's a search for where, if at all, a business has what's known as competitive advantages. These need to be sustainable. This isn't just for a week or a month. These are genuinely significant, sustainable advantages that a business has over the competition. If it doesn't have any of those advantages, it really doesn't have any sustainable strengths. So a key part of identifying those strengths is to perhaps benchmark the business against the competition in terms of key measures. And linked into that is this idea of key performance indicators. Not 20 or 30 indicators, but what are the 3, 4, 5 key indicators of competitive strength? And do they indicate that the business has a strength or a weakness? The kind of things we might be looking for there as we look for things the business is really good at compared with the areas where it is weak would be measures such as market share, the proportion of the market that the business has, how profitable the business is compared with the competition. A key measure there is the operating profit margin, which is a key indicator of relative profitability. How efficient is the business? What are its unit costs? Is it able to operate at a lower unit cost than the competition? That would certainly be a key strength. Moving on to things which are perhaps a little bit more intangible, but not, to be fair, still measurable. To what extent does a business have strengths or weaknesses in terms of its brand, the customer loyalty? And then could you also have a look at measures such as market capitalization, the value of the business, as a measure of strength or weakness? Perhaps also some other measures or key performance indicators about quality, perhaps customer service levels, the market reputation for quality, the extent to which customers complain about the business. Those are all areas that benchmarking and key performance indicators could identify as either strengths or weaknesses. The key thing when you're looking at the top half of the SWOT analysis is to really focus on the most important aspects. A SWOT analysis is a weak one if it's listing out 10 or 20 points under each heading. So it needs to be on the most important factors, and ideally the judgment that's made about whether something is a strength or a weakness should be independent rather than just the senior management team doing their own SWOT analysis. Looking briefly at the bottom half of the SWOT analysis, opportunities and threats, remember, are external to the business. And one threat to a business could be an opportunity to another. It all depends on how you perceive the factor. We've done a separate video on a model called pestle analysis, which is a really useful way of identifying the key factors in the external environment. And then what the business needs to do in terms of SWOT is to identify whether those factors are opportunities or whether they're threats. The key with opportunities is, can you exploit them? Does the business have the resources? Does it have the strategy to take advantage of the best opportunities? In terms of threats, the key strategic challenge is, how do you defend against them? How do you respond? So, opportunities and threats. If it's an opportunity, the key issue, what do we do? How do we make the best use? How do we take advantage? Threats, How do we protect against them? And of course, this links really nicely with this whole issue of risk management and contingency planning. So overall, how useful is SWOT analysis? Well, I've mentioned already that it's quite distinctive in the sense it looks at both the internal and external factors impacting a business. And I think it's a fairly logical, easy to understand model, isn't it? Strengths and weaknesses, factors within your control, opportunities and threats, factors outside of your control. Done well, a SWOT analysis also focuses management on the key issues, the strategic issues. And in particular, it encourages management to look outside the business when it considers the external environment. Done badly, a SWOT analysis is usually far too detailed with too many points under each heading, and it lacks focus. And of course, a SWOT analysis is less useful if it's been done by the very team who make the strategic decisions. One final downside or weakness of SWOT analysis is that if you're not careful, particularly in a fast-changing external environment, the SWOT analysis can quickly become out of date. So you've got to keep on looking at the SWOT analysis and actioning it. That's been an introduction to the key management tool called SWOT analysis.